Well, good afternoon and welcome to our seminar on tax planning in 2021. We've got a new year, a new president. Do we have a new plan? Well, let's see where we are today. What we intend to discuss today is how we've always had an ever-evolving tax system, some individual planning ideas, business planning, and some Minnesota changes. Now, as always, this information is ever-evolving too. And your situation is different than anyone else's. So please use this information as general guidelines, but when you're making decisions for yourself, make sure that you get the most current information and sit down with the person that you work with, and then you come to a better answer. So we've always had an ever-evolving tax system. It has always changed. Change is not new. The pace of change may be different, but the fact that it's changing is not. The best example I have of that is the individual income tax system became official in 1913. The Constitution was changed to allow it. And when the system first started, the top tax rate was 7%. So what do you think the top tax rate was just 5 years later? Remember, the system didn't exist before that. So it went from 7 to what number within 5 years? Was it 17%? Did it more than double? Maybe it was 37%. Did it go up by a factor of 5? Maybe it was 57%. Or was it a staggering 77%? Believe it or not, the answer was 77%. We went from a non-existent system to a system with a 77% tax rate in just 5 years. Now, to be fair, if you think about it, 5 years after 1913 is 1918, and the United States is in the middle of World War I. So there was a reason for it, but we always have to watch for how the system evolves. Now, there were many, many changes talked about during this year. Many of these ideas came from the president's platform as he was running, and many of them were for some other reasons. So they were talking about increases in individual rates, moving the top rate from 37% to 39.6. Increases in the capital gain rates, moving the top capital gain rate from 20% to 39.6. In other words, almost doubling the top tax bracket and making some of those changes retroactive. They're talking about increases in business income taxes, not only the rate on C corporations or regular corporations, but the impact of business income taxes on pass-through entities, partnerships, and S corporations. Because if you think about that, they were going to get rid of potentially the qualified business income deduction. That would, in essence, have increased the top tax bracket on small businesses by as much as 20%. There's also talking about significant changes in the estate, gift, and trust taxes. Many other things were there, but there's a lot of it was the increases in the rates and some really large and remarkable changes. And all of these changes were looked at to help fund a very ambitious social program changes. So remember when the initial bill came out, they were looking at a cost of the bill of over $6 trillion. That's trillion with a T. So there were some very ambitious program changes. We're not talking about whether you agree or disagree with them. We're not talking politics for the sake of politics. Remember, politicians make the decisions. So we need to follow politics to understand who's making the changes and how to respond to them. Thank you. So now this bill now is called the Build Back Better bill, BBB, Build Back Better. This bill has passed the House. It is sitting in the Senate. They have not decided what will really happen in the Senate. But where things are sitting now, there are no changes in individual rates. None. But there are some new surtaxes. So that allows them to say that we didn't change the rates themselves. We just added in some surtaxes. That's not the same thing as a rate change. But those rate changes are at very, very significant levels. For a married couple, you'd have to make more than $10 million. That's not your assets, that is your income. Okay? So we're looking at a very, very high level of income there. For trusts it's with taxable income of $200,000. There's also this pass-through income or S corporation partnership income. If that income wasn't subject to self-employment taxes, they're going to say that you would be subject to the net investment income tax or Obamacare taxes, if you may think of it that way, of 3.8%. Furthermore, they're one of the benefits for some people is they're going to increase the SALT, that's the state and local tax limit, from 10,000 to 80,000. This change would be effective in 2021 if it becomes law. There'll be no more backdoor Roth conversions beginning in 2022, and some contribution limitations on large retirement accounts, but not until 2031. And then early in the 2021, they instituted a expanded child credit of $3,000 or $3,600 per child, depending upon the age of the child, for 2021. Now, as part of this bill, it would also be there for 2022. So there's a lot. That is kind of what it's been slimmed down to. So notice that most of the big things that we talked about are not in the final, and not in the bill as it sits today. It can be changed. It's likely to change in the Senate, but the changes tend to be more taxpayer friendly as time went on, and the changes are not as broad as originally envisioned, as originally planned. So Matt, do you want to talk a little bit about what, based upon where we are, what we should do as for individual planning?
Yeah, absolutely. So I'm going to be covering a number of traditional tax planning ideas that you may have heard in the past. Maybe you hear them every year, so this might be partly a refresher, but I think there'll be some things that will have will be directly impacted by these pending tax law changes. So the first thing I'm going to talk about is some charitable contribution strategies that you may want to consider putting into play. So you likely recall back in 2018, they increased the standard deduction, basically doubled the standard deduction. And because of that, many taxpayers are no longer itemizing deductions. So many people that were getting a benefit for making charitable donations maybe aren't anymore. So a couple strategies here that you can consider using would be using a donor advised fund, or possibly just bunching your donations. Bunching donations, it's exactly like it sounds. So if you are someone who is typically donating, say, $10,000 a year, every year, but you're still taking the standard deduction, you're really not getting much of a tax benefit by doing that. Now, you may be getting a little bit of a Minnesota benefit, but at the federal level, no benefit there. So the idea of bunching means maybe instead of doing $10,000 every year, maybe every 3 years you're doing a $30,000 donation, and therefore you're getting the benefit for it on Schedule A of your personal tax return. A donor advised fund is a tool that can be used to help out with donation bunching. What this is a fund that you set up. Most of our clients that do it will work with a financial advisor. And what they'll do is contribute dollars into a donor advised fund, either cash or stock. And in the year they contribute to the fund, they get the deduction in that year. Then the money sits in that fund and you decide over a period of time how you'd like to disperse the dollars out of there, what organizations you'd like to give to, the amounts. You get to decide that. So you have a period of time to make those donations out of there. Now you don't get an additional deduction when you move the money out of the fund to the charity. You only get it in the year that it's contributed to the fund. Bunching donations can be a particularly useful strategy if you have, say, a one-off, super high income one year, and you want to make sure that you are getting the tax benefit for your donations. Maybe you want to bunch a bunch of them into that year, so you're getting a deduction in a higher tax bracket. Essentially, you're getting more bang for your buck by doing that. Now, if you determine that it's a good year to make a large donation, you may want to consider donating highly appreciated stock. The way that works is you're donating stock directly from your brokerage account to a charity. You get the deduction based on the fair market value of the stock or the securities at the date of the contribution, and you're not required to pick up the capital gain on the increase there. And so it's a double benefit. Now, it's important to note that you don't want to liquidate the stock first and then transfer the dollars to the charity. You're basically losing some of the tax benefit there because you'll have to pay capital gains tax on that appreciation. The next thing I'm going to talk about here is qualified charitable distributions. What a QCD is when you transfer funds directly from your IRA to a charity. In order to do this, you must be 70 and a half years old. Now, this age of 70 and a half used to be the RMD age. RMDs are now required at 72. The age for QCDs is still 70 and a half. As I mentioned, it's important that you transfer the funds directly from the IRA to the charity. And by doing this, that distribution is excluded from your taxable income. So you're getting a benefit for that. So I just want to go through a quick example here to kind of illustrate how this strategy can be useful. So in this example, we have a 73-year-old taxpayer. They're the 22% tax bracket. Say they're taking the standard deduction, so they're not getting any federal benefit for their donations. And if they're donating $5,000 to charity, that's great. It's great to give back and give to charity, but there's no tax benefit there. So in this case, if this taxpayer transfers that $5,000 directly from their IRA to the charity, that $5,000 is excluded from federal taxable income, and that taxpayer will see a tax benefit of about $1,200 between the IRS and Minnesota. So you can see there's a decent benefit by using this strategy here. One other thing to keep in mind by doing QCDs, if you are on Medicare, that by reducing your taxable income or your federal modified adjusted gross income, you're potentially reducing your Medicare premiums as well. So multiple benefits to be had by using the qualified charitable distribution strategy. Of course, there are limitations on the amount of your donations that you can deduct. For 2020 and 2021, you are allowed to deduct up to 100% of your AGI in cash donations. That was just a 2-year deal that Congress changed. And please note that if you're donating cash into a donor advised fund, it's limited to 60% of your AGI that can be deducted. Now, for non-cash items, such as things that you're donating to Goodwill, the limit there is going to be 50% of your AGI that can be deducted. And then securities, subject to a 30% limitation. Now, if you end up donating more than these limitations, those amounts will just get carried forward for up to 5 years, and you'll be able to use them to offset future taxable income. It's also very important to make sure you've got the proper receipts to substantiate the donation. And it's important that you have these receipts prior to filing the tax return. If you do not, and the IRS comes and audits, they'll be looking for that receipt. And if you don't have it, they're going to throw out the deduction. It won't be allowed. I'm going to talk a little bit about investments. Capital loss harvesting is something you've maybe discussed with your financial advisor. This could be a good strategy if you've got significant capital gains. Maybe you sold a business, and so you've got a bunch of gains in the current year. Maybe you want to look into your account and see what you have for underperforming securities, and maybe liquidate those and recognize those losses to help offset the gains. Watch for the wash sale. A wash sale is when you sell a security for a loss and then you go and repurchase it within 30 days. By doing that, you're not actually allowed to deduct the loss. We saw this actually quite a bit last year in 2020 when a lot of people started opening their own brokerage accounts through, say, Robinhood or Fidelity, and going and buying and selling, kind of as something to do during COVID when there wasn't much else going on. And those taxpayers found out the hard way at the end of the year, where when they had these transactions where they sold at a loss and then repurchased within 30 days, those losses were disallowed. We had a number of taxpayers that were caught by surprise with regard to that issue. Another thing to point out is that the wash sale rules do not apply to gains. So why I mentioned this is, if maybe income was low, really low in the current year, maybe your business had a loss, maybe you're in that lowest tax bracket, where if you recognize capital gains, you might be in that 0% capital gains bracket. So by selling stock and then repurchasing it right away shortly after, if you want to get back into the same holdings, you are going to recognize that gain, and there may be no tax on it, and you've essentially stepped up your basis. Capital gain distributions. So as we're getting closer to year end, these mutual funds are turning over their portfolios. They may be recognizing capital gains. So it may make sense to wait until after the year is over to buy into those mutual funds, so you're not forced to recognize capital gains on a brand new investment. Individual retirement accounts, quite a bit of information here. So in 2020, RMDs, required minimum distributions, were not required. Congress said, it was because of COVID, they said you don't need to take money out. And so some people took money out, they were allowed to put it back in. Either way, many people had lower taxable income in 2020 because they did not take their RMDs. Any of you who pay estimated taxes know, or likely know, that your 2021 estimated taxes were based on your 2020 tax liability. Well, if 2020 was low, your estimates were going to be based on a lower income. And now in 2021, when you're taking RMDs, if you haven't adjusted your quarterly safe harbor estimates, you're likely going to owe tax in April. Now, this may not come into play if you have withholding on your RMDs, and the withholding is generally sufficient to cover your tax liability. You should be fine. But if you're someone who's paying estimated taxes, this is something to keep in mind. Roth IRA conversions. So there are various reasons why accelerating income into 2021 might make sense, or even just in general, accelerating income by doing a Roth conversion could make sense. One example might be if the market has a significant decline. So if your account value has decreased significantly, it might make sense to do a Roth conversion, get those dollars into an after-tax bucket, and then allow that future, hopefully when the market rebounds, hopefully those, that account value will increase and you'll have tax-free growth there. Also, if you expect tax rates to go up in the future, which as Todd mentioned, it doesn't look like it's going to happen here for 2021 or 2022, but many people believe in the future they will go up. So you may want to consider doing a conversion to take advantage of what the known tax rates are at this point in time. Also, if you had maybe you had a business that had a tough year because of COVID, so your personal tax situation, your income was lower than a normal year, and you're in a very low tax bracket, maybe then it makes sense to do a Roth conversion. We generally recommend using up those lower tax brackets, making sure you're getting the full benefit there. So maybe use up those brackets by doing a Roth conversion. If you're in a situation where the estate tax may become an issue, it might be beneficial to your heirs if you pay some of that tax basically for them. Something to keep in mind there. And no RMDs are required for Roth IRAs, at least as the laws are right now. There's no RMDs required. So maybe you're currently taking RMDs out of your traditional IRA, and maybe you don't necessarily need the cash. Well, then maybe it would make sense to convert some to Roth, and then you can leave it in the Roth IRA. You won't be required to take it out. By doing a Roth conversion, of course, you are accelerating income. You're increasing income in the year that you do the conversion. So if you're someone who's on Medicare and you are doing a very large Roth conversion in the current year, that is going to impact your Medicare premiums. Now it'll be a 1-year hit, basically. Your taxable income will be very high this year. Your Medicare premiums will go up in 2 years, and it'll just be a 1-year deal. So it's just good to know that, what the future implications are of doing a Roth conversion. Also, as Todd mentioned briefly, there is talk. There is some proposals going around of potentially eliminating some of these Roth conversion strategies in the future. So maybe it makes sense to take advantage of these strategies now while they exist. Backdoor Roths may no longer be allowed after December 31st of this year. So what a backdoor Roth is, just to give you a little background on that, that's where if a taxpayer, their income is too high to contribute directly to a Roth IRA, what they do is contribute to an after-tax IRA, a non-deductible IRA, and then they turn around and convert that to a Roth IRA shortly after doing that. And then the funds from there are allowed to grow tax-free. And so it's kind of a loophole, and we see a lot of people take advantage of that. And so if this bill passes and it stays as it reads right now, that will no longer be allowed. And that's regardless of income level. It doesn't matter if you're very low income or very high income, backdoor Roths may no longer be allowed. Now I just want to run through a number of kind of odds and ends, kind of some miscellaneous things to keep in mind here as we approach year end. I briefly mentioned that the cap is currently $10,000 on the state and local tax deduction on Schedule A. The proposed change is to increase it to $80,000. There is some pushback by some Democrats in the Senate, and they don't necessarily want to give that much of a tax benefit, especially to high income earners. So we don't know where that's going to land at. If it's going to change, if it changes, what it's going to be. So this will be something just to kind of keep your eye on. This impacts a lot of people. Here at JAK, we work with quite a few self-employed individuals. And when we're having these conversations around year end, a very common question is, how can I reduce taxes? How can I defer taxes? One thing that almost always comes up is the opportunity to establish and fund a self-employed retirement plan. There are a number of plans available to self-employed individuals. There's different features, different impacts on your taxes. And so we generally like to have the discussion with the client, maybe get the financial advisor involved and help determine which plan might make the most sense for the taxpayer. So self-employed retirement plans can be established retroactively for 2021. This didn't used to be the case for all retirement plans. It used to be limited to the SEP IRA. Well, now I guess it started in 2020 and now in 2021. If we're working on your taxes in March or April, and we determine maybe it makes sense to establish a retirement plan. Well, we can have, or you can work with an advisor, or you can work on setting up a retirement plan that's retroactive to 2021, even though we would be in 2022 at that point. Another common thing we tell clients, if you're able, consider maxing out your HSAs. These are a very useful tool. Any contributions made to an HSA are deductible, and then the HSA dollars can be withdrawn from that account and used for qualified medical expenses. And as long as you do that, the distributions are tax-free. We also usually recommend, if look into the investment features in your HSA. There is I think it's somewhat unknown that there oftentimes is an investment feature in there where you can choose mutual funds to invest in. So ideally, your funds are going to grow tax-free over time. It's important to note that if you're on Medicare, you're not allowed to contribute to an HSA. However, if you have an old HSA that you've accumulated over the years, you can still use that money to pay for qualified medical expenses, including medical premiums. Also consider 529 plan contributions. These are the accounts that are used for qualified tuition and education expenses. So a taxpayer, maybe a grandmother or grandfather, contribute to a 529 plan on behalf of their grandchildren. If they put that money in when their grandchild is 3 years old, and then that money has 15 years to grow until the time that kid goes to college, and then they go and pull that money out of the 529 plan and use it for tuition, those dollars and any growth in that account are tax-free. Within the last couple of years, Congress changed the rules a little bit, allowing for taxpayers to take up to $10,000 a year to use for K through 12 private and public school tuition. So something to keep in mind there, just another little consideration, I guess. As we approach year end here, we are talking with quite a few clients, and if they don't talk with us, we advise that they look at their withholding. Maybe look at your most recent pay stub. Take a look and see if your withholding appears that it's going to cover your tax liability. If it's not going to, there's not a whole lot you can do at this point in the year. It's hard to make up for, if you're under withheld throughout the year, but I think it's helpful to know if you're going to owe, roughly what you're going to owe, so you can plan for cash flow if you need to start setting aside money now to help pay that balance due. These last couple things here. So the stimulus checks, everybody's heard about the stimulus checks. The IRS issued 3 different rounds of stimulus checks. The third one was in March of 2021, and it's going to work similar to 2020. So the March 2021 stimulus checks were actually an advance payment for a credit that will be claimed on your 2021 tax return. And so if you didn't get it, but you'll be eligible based on 2021's income, we will claim it on your tax return. If you did get it, we'll want to know, and it'll be important for you to tell us exactly how much you received so we can properly report that on your tax return. I heard a number of horror stories from other CPAs where their clients in 2020 provided them incorrect information. They told them different payment amounts than what they actually received. And because of that, the taxpayers' refunds were held up. And in some cases, I heard over 6 months. And so it's important to make sure you have this information available and provide it to your tax preparer. My comments are similar with regards to the advanced child tax credit payments. So the advanced child tax credit, or the child tax credit will be claimed on your 2021 tax return. And if you received any payments between July and December, those will reduce the amount of credit that you're eligible for on your 2021 tax return. So it's the same idea there. If you received any of these payments, you got to make sure you let your CPA or tax preparer know what they were so that we can properly report them. We don't want your tax refund being held up any longer than it has to be. With that being said, I'm going to jump back to Todd. Todd's going to talk a little bit more here about some business tax planning ideas to keep in mind here for 2021.
Thanks, Matt. So when you're looking at business planning, there's a couple things to keep in mind. One is a minor tweak, but it's effective for this year, is your restaurant meals are now 100% deductible. That versus just 50% deductible. So we just want to watch that. These may have additional deductions there depending upon what's going on. Also, for those of you that are paying your employees a per diem, the part of the per diem that's for meals is deemed a restaurant meal and 100% deductible. Now, depreciation, there's ways you can deduct a lot of things up front very fast, either through Section 179 expense or from the bonus depreciation. But think about, should you be moving depreciation faster or slower? Depending upon your situation, the answer may be different. Depends on the kind of year you're having, the other types of income, and what is going on. So the answer isn't always take things as soon as you can. You want to take it so that your tax is the lowest over the years, not in any one single year. It's just one of those things to keep in mind. Move to the next slide, Matt. But most of what we're talking to our clients about this year is the alphabet. Now, the alphabet this year is not the ABCs. It's PPP, ERC, and PTE. So what are they? Well, the PPP is the Paycheck Protection Program. I'm sure you've heard significant about it. It was a big deal in 2020 and early 2021. It's where the business received a loan, and if the dollars were spent in a particular way, the entire loan would be forgiven. Why are we bringing this up to people now, since the PPP program has been fully utilized and fully loaned out? It's because you want to make sure you apply for forgiveness in the proper way. So not everybody has applied for forgiveness, especially for the second round of PPP loans. So what we want to do is, if you haven't applied for forgiveness yet for your PPP loan, please contact somebody so we can coordinate with the next part of the alphabet, the ERC, which we'll get to soon. Because what you really want to look at is, you want to, in the PPP program too, the forgiveness itself is tax-free income. Tax-free income in people that have pass-through entities means their basis goes up. Well, that has a big impact to people who may have made loans into their businesses that are getting payments back. The timing of when you would allocate this forgiveness income has an impact on that. In November of 21, the IRS changed the rules to the taxpayer's benefit and gives you a choice. If you want to allocate the income in the year the expenses were incurred, or when you applied for forgiveness, or when you received forgiveness. Whichever is most beneficial to you, you can choose to do. So it's an opportunity to look back and see what you should do. I know we have a few clients who will be filing some amended returns to take advantage of this opportunity. You may want to look at it for yourself. You want to move to the next slide, Matt. So what is the employee retention credit? I briefly mentioned it in regards to PPP. The employee retention credit is if your revenues dropped a certain percentage, or if the government actually put restrictions on your business for how often they could be open, the employer could receive a credit, this employee retention credit, based upon payroll and health insurance paid with different caps. In 2020 itself, there was an annual cap of $10,000 per employee. or a $5,000 credit, because you're allowed a 50% recredit. In 2021, the credit got significantly augmented to a $10,000 amount per employee per quarter, and a 70% credit or a $7,000 credit for 3 quarters of the year, or $21,000. Why is this important? Why weren't people looking at it? Because until the end of December of 2020, the rules for said that if you got a PPP loan, you could not take advantage of the employee retention credits. Well, now the rules have changed in the end of December. They're retroactively changed to say you can do both. So you need to coordinate how you're applying for forgiveness to make sure that while you can get both, you can't use the same expense for PPP forgiveness and for the ERC. It's one or the other, no double dipping. And a proper coordination can make a big impact. We're seeing clients with 6-figure, almost 7-figure credits in a quarter if they qualify. So it's very important to look at this and whether or not it qualifies. I don't want to go through all the rules because they are technical, but just know that if you had an income impact in a quarter, and that income impact was at least 20% or somewhere right around there, please look at it or contact us. We can help walk you through some of these opportunities. So the next thing is not a federal change. It's a Minnesota change. It's the pass-through entity tax, or PTE. This is a new Minnesota option to work around the state and local tax limitations. It was actually one of the easiest things we've testified for at the Minnesota legislature. It was a pretty short discussion. It was, you can do this to help small businesses. You can treat small businesses similar to large corporations, and it won't cost the state of Minnesota a dime. So, and that is true. It helps out the taxpayer without impacting the state budget. And it's treating pass-through entities as corporations and partnerships similar to what they would have been if they were a C corporation. So I'm going to spend a little bit of time talking about this. So what you do is you pay a tax to the state of Minnesota. It's based upon your apportioned income times the top tax rate. And that means, and then you're allowed to deduct that tax against your federal income in the year the tax is paid. Well, all I've talked through now is just paying more money out. However, on the Minnesota income, what happens is this tax paid is added back to your Minnesota taxable income, but then you receive a credit on your personal tax return for the taxes paid. So the math comes back that you pay your Minnesota tax, you get a credit for what was paid. So therefore, I don't see it. Therefore, I'm not hurting the taxpayer with the extra taxes paid. But on a federal level, the taxes paid are reducing the flow through income, thereby making the taxpayer better off. Well, this is effective for 2021. Now, many of you may have already paid your estimates for the first 3 quarters on your pass-through entity, on your personal return. For you to get this benefit of this deduction, the business will pay tax on 100% of its income in in its fourth quarter estimate to the state of Minnesota. So yes, there'll be a duplicate. You paid part personally, then the whole thing's going to go on the business. The true up comes after you file your return, and you then get a refund of the excess individual taxes paid. So what happens if the entity tax is paid in 2022 versus 2021? You still receive the credit for the taxes in 2021. The credit's based upon the actual income times the rate. Then the deductions based upon the taxes paid in the tax year. So if additional monies are paid outside the year, you get the deduction later. If there's a refund of excess payments, that'll be picked up as income later, but the credit will always be in the tax year of the entity. So what you're finding out is that do you want to pay the deduction in 2021 or 2022? Like all good tax answers, it depends. It depends on what you expect are going to happen to rates. Now, right now, as Matt said, we don't think rates are going to change, but the net investment income tax, that 3.8% tax, might be assessed against you in 2022. That's in essence a tax increase. So maybe you'd be better off paying the dollars in 2022, receiving the credit in 21, and reducing your 2022 flow through income, and thereby reducing your net investment income tax. So about a 4% rate of return. Who would be a good candidate for paying the taxes in December? Well, it'll be for businesses that really monitor their cash. So if they think the owners really want to make sure that any excess cash is distributed, you're going to want to make sure that you pay this tax out in December so that the tax is paid out. It's not excess cash. And then you're going to, then you have a better feel for where you really are. Or you may have more variable income, and 2021 is a good year and you're not sure about 22. You want to make sure you get the deduction in a year when you know what the income is. Go ahead, pay the money in 21. Or people that really want them, that are really worried about cash flow. So if you're really worried about cash flow, and you want to do everything you can to reduce current taxes, then pay it now. Like I say, it depends. Now, what about if the Build Better Back expands the state and local taxes? Will this impact your pass-through entity tax choices? Yeah, but it's still it depends, because the pass-through entity tax is a business deduction, and it will reduce your qualified business income. That may reduce your QBI deduction. You may or may not be itemizing currently. That'll impact it. And don't forget our old friend AMT, the alternative minimum tax. One of the biggest culprits of creating the AMT for our Minnesota taxpayers was the Minnesota income tax deduction. Well, when we have a higher Minnesota income tax deduction, we're at greater risk for paying AMT taxes. So it is a true, it depends. If I decide to pay the pass-through entity tax to the state of Minnesota, do I have to do this every year? The answer is no. But once you've made a choice for a tax year, you have to stick with it for that tax year. Are there other states that have a pass-through entity tax? Yes, last I counted, it was 19 different states either have it now or will be having it in 2021 or 2022, pardon me, 2022. Some have been around for a while. Our neighbors to the east, Wisconsin, was one of the early adopters. It has a different system than Minnesota, but similar impact. So there are other states doing it, but you really have to look at how each state is done, and whether you're a resident or not, it's a very complex decision. So reach out. But just keep in mind that what we're trying to do here, you have to spend a little bit of time looking at it, is when you try to treat a pass-through entity like a C corporation, you end up with some different answers because of apportioned versus non-apportioned income. You end up with some different answers because as a business deduction for a partnership, this gets allocated based upon income or loss sharing ratios, which may be different than how the overall income is allocated due to guaranteed payments. So like anything, it can be a very complex decision. With that, are there any other Minnesota issues we should think about, Matt?
Yes, Todd. I'll just spend the last few minutes here going over a number of Minnesota changes to keep in mind. So in 2020, back when we were filing individual and business tax returns in February, March, April, we knew that the PPP loan forgiveness income was non-taxable on the federal tax return. We also knew that taxpayers' unemployment income would be excluded up to $10,200 on their federal tax return, as long as their adjusted gross income was less than $150,000. At that time, Minnesota's law still said that those types of income were still taxable. Well, as of early July, Minnesota changed the laws and they now conform with the federal treatment of those items. So Minnesota has said, do not go back and amend these tax returns. We will automatically adjust these. So starting in October, Minnesota said they'd be adjusting about 50,000 returns a week was their goal. And so we figured based on that timing, these refunds would be rolling into taxpayers until sometime in January. We've noticed some of our clients starting to get these refunds here recently, so we know they're coming. On the contrary, some taxpayers will actually owe some money related to 2019 and 2020. So reason being is there was an error in the Minnesota instructions that they provided to the tax software companies. The standard deduction limitation was being reduced by 20%, which was incorrect. Instead, it should have been reduced by 80% for taxpayers who were married, took the standard deduction, and had federal AGI over $360,000 or $280,000 if you were single. So if you fit this criteria in 2019 or 2020, you will likely owe some taxes. And basically, we've figured that the largest balance due anybody's going to owe for a particular year will be about $1,500. And that's, most people are going to be on the low end, closer to $500 or less. Those notices are expected to come out here sometime in January or February is what they're thinking. So just keep that in mind if you get a notice. This could be what it's about. Section 179, expense and conformity. So prior to 2020, Minnesota they basically allowed $25,000 of Section 179 expense, and the rest needed to be carried forward to future years. Deductions should be taken in future years. I should back up just a little bit. So what Section 179 is the code section that allows taxpayers to write off the cost of a newly acquired asset. Maybe a construction company buys a bulldozer. Section 179 allows them to write that off for federal tax purposes. Minnesota had the limitations. Now starting in 2020, going forward, Minnesota has conformed, so they allow full expensing as well. Minnesota also allows previous carryovers of Section 179 to be used in 2021 and going forward. Just a few more things here, a couple notable non-conformity items. So we've become very used to having items that Minnesota doesn't conform with the federal tax laws on. One of them being the employee retention credits that Todd discussed. These are essentially taxable for federal purposes. Minnesota says they're not. So there's actually a subtraction on the Minnesota tax return where you're allowed to deduct your credits. As Todd noted, the IRS or the Congress has allowed 100% deduction for business meals. Minnesota is still only allowing a 50% deduction, so you'll actually have to add back the additional 50% that's disallowed. And then not net operating losses. So if your business had a tough year, you had a net operating loss in 2020, Congress is allowing taxpayers to carry that loss back 5 years to offset income in a prior year. Minnesota has not conformed with this, and so Minnesota says you'll need to carry forward that loss and you'll be able to offset future income. So some of these things create kind of a record-keeping nightmare, but I think we've become used to it over the years, and so that's just the way it is. So with that said, that takes us to the end of our presentation. We have just a few minutes left here. I see we have some questions in the chat. I'll try to go through these, and whatever we don't get to, I think we'll try to follow up afterwards. We have whoever asked the question we'll follow up with. First question is, what is AGI? That's adjusted gross income on your federal tax return. And what is a DAF? That's a donor advised fund. The HSA is a health savings account. Question here says, can I do a QCD from my SEP? So a SEP, Todd, maybe you want to jump in here.
No.
You cannot.
The answer to that is no. You can't move your retirement plan dollars to a QCD. I thought it was DAF. So you can do a QCD from your SEP if it's a SEP IRA. It's a SEP IRA.
Someone has a question. Are 529 plan contributions deductible for the grandparents who created the account? Good question. So Minnesota allows either a deduction or a credit for 529 plan contributions. Depends on your income level. So there's a little Minnesota benefit there. It usually comes out to a maximum of about $300 in tax savings. There is no benefits on the federal tax return other than when the money's taken out, it's excluded from taxable income if it's used for education. What income should I be under in 2021 to qualify for stimulus checks for a married filing joint person? I believe it's 150,000. I don't think those income numbers change from the initial round of stimulus checks. So between 150,000 and 200,000 for a married couple, that credit begins to phase out. I got one more question here. I think we can sneak it in. For 2021, can all expenses incurred for mission work be deducted, including the cost of boarding one's pets? What are the requirements? So I think that's going to depend on
getting the receipt. It's going to be getting the receipt from the organization. Remember, like Matt said, no receipt, no deduction. Doesn't make any difference if it was a real contribution. You must follow the detailed rules. So our people that are doing the mission work, what you really want to do is you need to get either an in-kind contribution receipt from the mission saying that, are you doing in-kind work or are you donating the dollars there? It's a tricky road to hoe, but it can be done.
All right, well, that does it for the questions in the chat. We thank you all very much for attending. And as you see our contact information on the screen, please reach out if you have any follow-up questions, and have a great rest of your day.
Thank you.